So hello and welcome to this video. And in this video, my intent is to help you to understand the basic balance sheet equation, or sometimes called the accounting equation. I even prefer to use the term the business equation because of the many insights that can come from just understanding this equation. So, who would benefit from this video if you are an entrepreneur that wants to understand how finance works within its financial statements? This video is for you. If you are a finance person or you work in the finance department, you're going to enjoy this video. You're going to understand. If you have intentions of building financial models, this video is also going to help you in understanding how to go about your three financial statements, or how to build your three financial statements. Now, in this video, I'm trying to use just diagrams to help you to understand what is really happening in the financial statements. So, what we'll be covering in this video, we'll be looking at the basic balance sheet or accounting equation. We'll be extending it in order to understand what are the parts that make it up, and we will further extend it to the point where we can be able to see what parts makes up the income statement and what parts makes up the balance sheet or the statement of financial position. Then we would want to understand how do we get the cash flows, where do the cash flows come from, and we'll want to get all of this in this video. So let's start with the first one. So the first one helps us to look at the basic accounting equation. Here in the accounting equation, we're saying that if you've got equity plus liabilities, you definitely will be able to get your assets. So that is what is happening here. You've got 300 here, you've got 700 here. So in the accounting equation, it's expected that your total assets would come to this 1,000, which is the sum of these two of them. Now, when we look at these, we ask ourselves what is really going on here. So if you're an entrepreneur, or if you are just a business person, equity simply is whatever owner has brought into the business to come and start business. So this situation that we see, here, actually is that time when the business has not yet started, but when you just have things to do. So when we talk about equity, we're talking about things like savings that you have put together to start the business. And then when we talk about liabilities, like equity, it could savings, it could be contributions from willing partners. So a group of persons can come together, put some money together, and say, okay, we want to start a business. So they also might go to do some borrowing. And these borrowings, they put them together and then start to do the business. The borrowings is with the aim that they will pay interest for the money borrowed, and they expect that the business will yield the return that's higher than the interest rate, and that is why they do that. Okay, so but the takeaway here is that your equity and your liability must sum up to what's the value of your assets. You'll get to understand this better when we go forward. So let's go to the next. Let's see what it is if we extend it beyond that. So when we extend it beyond that, this is what we see. So here, let me just take this out so it doesn't distract that much. So after this stage, we see that here the business has started. So this is more like before the business starts. This is before the business And this is after the business has started. And yes, this is after the business has started. Let me just do this equal, and here this is after the business. So the business has started, and why do we say that the business has started? Because we can see retain earnings here. You see that we can see retain earnings here. So let me explain this for you so that you understand what is actually going on here. Okay. So here the business has started, and sometimes you find out that the business might have earnings of, let's say, 50 bucks here. So it has done business and it's able to get 50, or that is after expenses and after all the spendings that might be, it gets 50 bucks. And recall that in the previous visualization, capital, uh, capital, which is equity is broken down to retained earnings and capital. So assuming we have our retained earnings and our capital here, so you can see that in this case, the owner's equity grows to the owner's equity has grown to something about 350. You get. Now, what happens if he makes a loss? Because retained earnings comes from the operations of the business. So, what happens if he makes a loss? So, I'm going to just assume that this is a loss of 50 bucks. So, you can see that it reduces the owner's equity. So, sometimes when you look at financial statements and you start to see that equity is negative, it simply means that the business has not been making enough profit in order to keep equity positive. So what we're saying here is that a loss would reduce equity, but a positive return would increase the owner's equity. Okay. So what about liability? Here, liability is now the current liability and the non-current liability. So what do we mean by current liability? So we already know that liability and indebtedness, they are obligations to other parties outside the business. So we use borrowings to illustrate it. So, but here, there might be borrowings that you would pay within 12 months, not more than 12 months. So, and there might be borrowings, so let's say borrowings that is less than or equal to 12 months. You get it? And here we're talking about borrowings. Now, these borrowings can, just using borrowings to represent them, they could be in different forms, as you're going to see later. So, we could have borrowings that are greater than 12 months. So, they are greater than 12 months. So, when it's greater than 12 months, it is termed a long-term liability. And so we call those ones non-current. So the business might think that 700, let us have about 300 of it here, and then let's have 400 of it here. So that would now equate to 700 that you actually had before. So the sum of these two gives us our 700 that we had previously. So what happens is that after the business has started, you might find out that your your equity plus your liability increases by 50. Reduces by 50 because there was a negative here. So if it was positive, it's going to increase by 50. Okay, so that is exactly how it works. All right. So what does that imply for our assets? Now, when you have a business, the belief is that whatever money that you have gotten from all of your equity plus your liabilities, you are going to use them to finance assets. You're going to use them to finance assets. Now, it is ideal current liabilities to finance current assets. You get the current liabilities to finance current assets. So we might just take it this way that, okay, you know what we will do is that we are just going to take the current liability and possibly take maybe about 100 bucks from, take 100 bucks from capital, add it to this current, and then use it to finance everything about the current. Now, I'm going to show you different types of items that are in the current asset. But here, I just want to tell you that at the end of the day, what you're going to have as your non-current asset will be everything, would be whatever is your total, whatever is your total, from your equity and liability, you get it, and take out what the, current is, you get it. So it must come together to make the same thing. So if this entire one here gives you, it gives you 950 here, whatever you're going to have here should give you the same thing. Because, like I mentioned, you're using whatever you got from your, let me just make this one really clear. And then have this one. Take the format picture. Okay, all right. So what I'm trying to help you see is that whatever you've gotten, whatever the total is from equity and liability, we are using it to finance the assets. We are using it will be sitting in current assets, or some of them will be sitting in non-current assets. So it's usually ideal, like I mentioned recently, that you should be using your current liabilities to finance your current assets, and the non-current liabilities to finance your non-current assets. That's ideal. But in business and in reality, this might have some little variations, depending on how the finance of the business is managed. So that's for that. But whatever it is, these two must match, and this is by the match. Now, let's go further and extend it and try to see what exactly is happening within these items here. So now we're here. Here, we're trying to show that in your retained earnings, what makes up your retained earnings is the net contribution from revenue, cost of sales, OPEX, finance costs, and taxes. So if I have revenue and I subtract my cost of sales and I subtract OPEX and I subtract finance costs and then tax, I should be able to get my retained earnings. So what this actually entails is that if for my retained earnings is that if I have my revenues, I take out my cost of sales, I take out my OPEX. OPEX represents operating expenses. I take out my finance costs. I take out my my tax out of it. What I end up with is retained earnings. So if you're looking at a financial statement, and you want to really understand what is going on within the financial statement, you can determine retained earnings by just doing the net. So you see revenue is a plus, all others are minus, they are subtractions, and anything that brings in cash, anything that brings in sales, brings in money, would then be a plus, and everything that is an expense would be minus or negative. Okay, what about the capital? So the capital is going to be contributed capital. Either if it's a sole proprietor, it's going to be that which comes from him and him alone. If it's a group of individuals coming together, then it's going to be capital contributed by all of them. And then the only thing that might reduce this capital, that's within the capital, recall that I said that liability has got a current and a non-current. So in this current, I've just taken a few examples of the many items that can sit in your current liability. One of them is your trade payables. Now, your trade payables come from people who supply you maybe raw materials, supply you goods to sell, and all of those things. So they may have supplied it to you, and you didn't pay them at that point in time. Because you're credit worthy, they are saying that, oh, you can pay in 1 month time. So they are going to sit in your books as a trade payables, or they're going to sit as payables, things that you're going to pay in the near future. Recall that because it's current, it definitely must be less than 12 months. So they're going to sit inside here. There might be some expenses that you've not yet paid for, but you've enjoyed the services. So those are accruals that are going to come in. For example, you might have used things like utilities, and you're expected to pay that utility at the beginning of the following month. So in the current month, it's going to sit as an accrual in your books that you've enjoyed, a service that you're yet to pay. So all of these goes to, record your liabilities as regards what is happening currently. Now, the liabilities you find inside the financial statements, precisely the balance sheet, are also on an accrual basis. So it tells you, oh, you're owing 5. If you pay 2 out of it, okay, you paid 2 during this period, so the balance is going to be 3. If you added another 2 in the following month, the balance becomes, 5, and just like that. So we'll get to understand more of that later. So the non-current are long-term. So one of the examples are long-term loans. So you have long-term loans, long-term borrowings, long-term finances come into your non-current liability. So we put them there because there are ways you finance a business. You get it? So sometimes you're financing a business not through cash, but through borrowings from suppliers in order to keep your business running. Makes sense? Then all of that have a way of coming into your assets. You see, so in your current assets, we have cash. So sometimes it's not every time you're paying off all what you are having, or you're using your cash to take care of everything and leave your cash empty. No, it doesn't happen like that. You always have a minimum cash level that you have to take care of what? Current obligations. So that is what we see here. And so you have that cash that is therefore current. You have trade receivables. So trade receivables is like the opposite of trade payables. This time you have given your customers goods and they expect to pay it back to you, within some time. You get it? So in such situations, if you've done that, yes, you've made sales, but you're yet to collect payments for those sales. That transaction is going to sit in your trade payable. So it sits in your sales, which is in your income statement, and also it sits in your trade payables, indicating that you are yet to get them. There are also things like prepayments. Those are things that you have paid ahead of. For example, utilities. You may have paid ahead for utilities and you are yet to enjoy the service. You can record that as a current asset. Yes, it is a current asset. The reason being that in the business, it has acquired the rights to enjoy that service and it is yet to enjoy it. So it sits there as an asset. Then we have the non-current assets. So your non-current assets sometimes summarized as PPEs, property and equipment, plant property and equipment. So your non-current assets is made up of all of these items, like you can see here. So just hit 104 and then bring it back to what it is. Okay. So it's made up of all of these items. Now let's go and start to look at where is the income statement and where is the balance sheet in all of these diagrams that we have seen here. Which of these items make up the income statement and makes up the balance sheet? So that's the next thing we're going to see. And what I'm going to do is just going to make it a little bigger. And here we go. Yeah. All right. So here you are able to see where the income statement is and where the balance sheet is. So you will notice that everything about the retained earnings is actually coming from the income statement. So there is a part of equity that comes from the income statement, and there's a part of equity that comes from that is from the balance sheet. So the part that pertains to retained earnings is always coming from the income statement. So the retained earnings is more like a summary of the income statement within the balance sheet. Now, what about the capital? For that of the capital, you're going to find it in the balance sheet. So that is why you see every other thing here would be in the balance sheet. So one thing I want you to notice is that the balance sheet captures everything. It captures everything. The only thing is that the balance sheet takes the retained earnings as a summary of the income statement and puts all of them in one place. So because we want to understand what has happened in the current period, the income statement helps us to see all of that for every current period. But the balance sheet takes a summary of all of these transactions, and it is doing that cumulatively right from when the business starts to wherever the business is going. So it captures everything of the business. It accrues everything of the business up to any given point in time. So that's what the balance sheet does. For the income statement, you are able to see for each period what happened within that period. So it's in other words captures the income statement used more or less the matching period. So what happened in this period, match it to this period, report it, and then we get it. The balance sheet is more like an accrual of many periods up to a point in time. That is what it does. So that is what we see in here. All these other items that we have discussed would be in the balance sheet. So now, let us look at it and ask ourselves that, if we've understood what the income statement is, we understand what things makes up the income statement, we also understand what things makes up the balance sheet. We should now ask ourselves, what makes up the cash flow statement? Well, here is it. In the cash flow statement, we have these three major sections of the cash flow statement. And those three major sections are the cash flow from operations, cash flow from investing, and cash flow from financing. Now, why are we doing this? Because the cash flow statement helps us to determine how much cash came in a particular period. Remember that the balance sheet does not do it for a particular period. It doesn't matter. It's telling you from when the business started to what it is now. This has been the state of the business in terms of equity, in terms of liabilities, and in terms of assets. But within this equity, liability, and assets, so what has been the cash movements that has taken place? What has been the cash out and cash in of the transactions that has taken place within a particular period? The thing is that we use the balance sheet to derive these movements. So the cash flow statement is a derivative from the balance sheet. Now, for some individuals, when they do financial modeling, when they build models, there are those who create the cash flow statement before they go and use the cash flow statement to develop the balance sheet. Yes, it's possible, but I don't advise that. I don't use that. So what I do is get my income statement, get my balance sheet, and from my balance sheet, I derive my cash flow. I tend to find it easier with this method to be able to detect if errors are in my analysis, and where the errors are coming from. It makes it easy to get it, and then you can easily fix it. And it also makes it easy for you. It's like a two-way check. You get it. So you have, in one way or the other, spent some cash. You have given out or got some cash, but the balance sheet recognizes it, and by the time you derive your cash flow statement from the balance sheet, you are able to check, is this what really happened? You get it, and then you might be able to correct one or two. Okay, so actually, what happens is that the cash flow statement presents cash in and out in these three major headings. Now, let us see how it works. Let us see how it works in this diagram here. So, everything that has to do with your cash flow from operations comes from these green areas that I've mentioned here. So part of it comes from your income statement, and that is why when you are producing your cash flow from operations, most of the time it's going to start from your net profit. You get it? It's going to start from your net profit for the period, and then you cascade it down to look at other things. So, but for now, I just want you to know that your net profit from your income statement is almost the first thing that you would bring in order to get your cash flow from operations. So cash flow from operations does not just come from just that. It also comes from your current liabilities. So your current liabilities is saying that, okay, take for instance your trade payables. Even if I secure raw materials from my creditors now, it's a form of cash, because actually the exchange in value for those raw materials is cash. So my creditor giving me those raw materials to go and work with, or maybe giving me goods to go and sell, is more or less financing my business. But this time around, it is doing that through trade payables. You get it? So I have to record it in my cash flow from operations, current operations, and it will be as this trade payables will be like cash that comes in. So your creditor gives you raw materials. So now try to look at it from value in exchange. Your creditor is indirectly giving you cash, and that is why we record it in our cash flow from operations. Then we have the assets, which are current assets. Remember that for the assets, I am buying these assets, or I am bringing these assets into the business. So you can see that in these current assets, if it is trade receivables, those are sales that I have made. You get it? And I'm looking forward to cash coming into the business in the near future. So they are assets to me. Just imagine that a trade creditor gives me raw materials of maybe $50, and I've transformed these raw materials and I'm selling it for maybe $80. So $50, $80, I have been able to make $30. So it simply means that I have assets waiting to be collected that I have provided services for in the near future. So I need to record it here. I need to record it in my cash flow from operations, as cash. So most of the time, the confusion people have about this thing is that, oh, I sold something, I have not received the cash, so why do I record it as a cash and all of that? So, but we need to understand that the exchange for goods and services almost often is cash. And so we can approximate trade receivables to be cash. We can approximate prepayments as cash, and that is why they come into the cash flow statement. So what about others? What about cash flow from investment? what places we will be looking at when we are discussing the cash flow from investing. Here it is. So when we are discussing cash flow from investing, we are looking at these areas. So you see the purple colored lines that are so this cash flow from investing. Yeah, cash flow from investing. So for cash flow from investing, what we are actually doing is that we are acquiring assets. So you're acquiring assets like office equipment, you're acquiring assets like buildings, you're acquiring assets like plants. And they are non-current because these are assets that are going to last for more than 12 months. You get it? So they are non-current assets and you're bringing them into your assets. Like I mentioned before, you're going to use cash from equity, cash from liabilities to finance your assets. So this time around, the cash that you use in financing your non-current assets needs to be taken care of here in your cash flow from investing or from investments. So you are putting money into the business to invest in, and that money you're putting into the business is more like investing into assets of the business. So wherever you go, you can go to your balance sheet and look for your non-current assets, and your non-current assets will populate cash flow from investing. Now that takes us to the third one. This time around, we are looking at the cash flow. We are looking at the cash flow from financing, or the financing cash flow. So financing is everything that brings money to be used in the business. You get it? So this time around, you can see that the blue colored lines are taking us to capital. So cash can come from equity, contributions from partners or owners of the business. It can come from there. So it's going to affect this area. If cash comes in, maybe the owner brings in more cash into the business and all of that. So cash comes in that way. Cash can also come in from borrowing. This time non-current borrowing. That is what we look at in this case. We are not looking at the current ones. We're not looking because those are just for current. But the long-term or non-current borrowing would be recorded in cash flow as cash flow from financing. So it's going to affect these two areas. So by the time you touch all the areas of the balance sheet, you automatically would have gotten your cash flow. You would have gotten your cash flow statement, and it will come out beautifully and fine. Now, what I have just done here is to show you in diagrams the financial statement and what affects what, when what changes. That is what all of this is all about. And I want to believe that you'll be able to understand how all of this translates to the three financial statements. Now, if you want to see how the three financial statements are developed, this time not in diagrams, but using figures to build the income statement, to build the balance sheet, and to build the cash flow statement. That is something I think you would love to have, but I would like to know if you would love to have that. If I could have as much as 100 likes on this video, I will definitely go and produce that. I'll definitely go and produce that for the financial statements using figures, and I will be referring to these diagrams to show you that what you have previously learned helps you to develop those kind of statements. So I would appreciate if you can subscribe, if you can share, if you can like, so that it promotes the video, and it helps everyone to have a better understanding of the three financial statements, how it comes about, right from the accounting equation and down to the three statements. That is the income statement, the statement of financial position, and the cash flow statement. So thank you very much. I hope the video helps. I'll see you in another video.